Hello and welcome to the Market Share, your first source for market information. I'm Paul Gifford, Chief Investment Officer. Joining me today, Erik Clapsaddle, our Senior Fixed Income Portfolio Manager. Erik, been doing several presentations recently and always have included that we've had a lot of once-in-a-lifetime, once-in-a-century event that investors have had to deal with over the last couple years. We had yet another one Friday night, after hours, kind of in the middle of the night. Moody's, a rating agency, downgraded the United States from AAA to AA1. Moody's had the United States government as AAA since 1919, 106 years, and we finally got downgraded. How is the investment market taking that?
Sure. So the downgrade didn't really come as a surprise. No one's going to know, to Paul's point, the date or time that it comes. And realistically, the U.S. credit rating at AAA by Moody's was probably overextended. A huge tax base, diverse, robust economy, all kept our credit rating probably higher than where it should have been for the past few years. Matter of fact, S&P downgraded us in 2011 from AAA to AA+. Fitch did the same in 2023. And Moody's cited widening fiscal deficits, rising total debt, and a bigger concern now is the rapidly rising interest costs on our debt as elements that don't line up with other sovereign governments and sovereign debt around the world. What I kind of like to strip out from there is you think about the seasonality of political parties in DC. One thing that they both have in common unequivocally is large fiscal deficit spending. You'll see on the chart on the screen, the U.S. has had a fiscal deficit for 23 consecutive years, and that deficit has accelerated since 2020. Most people all come to the same agreement in investing world and in the general population, and that is the United States government just has too much debt. And these widening fiscal deficits are only going to make that worse.
And as we know with those fiscal deficits, they're running about $2 trillion a year now. So we spend 7 and collect 5 basically. That's not sustainable. Yeah. Can you talk a little bit now about how we are actually spending that budget at the government level?
Yeah, so just thinking initially, there are major agencies, departments, components of the government that are going to be very difficult to reduce the size of. And you'll see the chart here that Social Security is easily the largest expense in the U.S. budget, but net interest on our debt, Medicare, health, national defense, and income security are not too far behind. The most concerning part of the U.S. budget, though, over the past few years has been the increase in net interest. It has gone from $584 billion for the trailing 12-month period ending in April of 2023 to $946 billion in April of 2025 for the 12-month period leading up to that. On top of that, thinking bigger picture about our debt and how we measure it, the U.S. total debt to total GDP has become a concerning matter. Historically, that number should be around 60%, meaning for every 60 cents in debt a nation has, they should have about $1 in economic output, GDP. Anything that hits 80% or goes higher is considered to be a negative effect on economic growth. Currently, the U.S. total debt to GDP is around 130%. I would say on an annualized basis, thinking in a normal year, worst case scenario, our economic output, again, growth of GDP, should outpace the growth of our debt. That has only happened in 2021. Recently, it has only happened in 2021 because of large fiscal stimulus late 2020 into 2021 from COVID. But you have to go back to 2014 and 2006 for that positive effect of economic growth outpacing debt.
Well, economic growth is truly a big part of what we need to manage the debt, besides managing fiscally responsible. The challenge has been first quarter of 2025 didn't exactly contribute positively to GDP.
Sure. So first quarter of GDP showed contraction in the overall economy of about 0.3%. It was forecasted to be around negative 0.2%. But when you see this chart, you'll see where it came from. Net exports, which are total exports minus total imports, pulled back 4.8 percentage points from GDP. That largely just came from the Trump administration putting tariffs on every country, largely around the world, or the expectations that they were going to do that. And virtually anyone buying foreign goods increased their purchasing of foreign goods during the first 3 months of this year, certainly the latter part of that. Clearly, all those tariffs and proposed tariffs have been pulled back since then. Again, we think a positive moving forward. Should have been much more targeted. Outside of that, the first quarter GDP number was pretty good. Federal government consumption pulled back a little bit, meaning it detracted from overall economic growth, which is okay. It should be a positive thing for the U.S. budget moving forward. The really good numbers inside of there came from things like consumption, personal consumption from consumers in this country, an increase in inventories, and last but not least, the really surprising but good number was fixed investment by businesses around this country.
That's really good data, especially about our debt and our ratios and some of the challenges we saw in the first quarter. Erik, really appreciate your comments. I know the viewers do as well. If you enjoyed today's content, I encourage you to share that with your friends and family. If you do not currently subscribe to the Market Share, you can do so using the QR code at the end of the video or emailing us at wealthadvisory@firstsource.com. And as always, thank you for the opportunity to serve you and your family, and have a great day.